Thank you, everyone. First of all, a very, very warm welcome. My name is Akash Chaudhary. I'm the learning chair for YPO. My partner Anupam Thoreja is the YPO Gold Learning Chair for this year. We are starting our first event with Mr. Mohnish Pabrai. Today, it's my distinct honor and privilege to introduce distinguished figure in the world of investing, philanthropy and thought leadership, Mr. Mohnish Pabrai. Mohnish is the managing partner of Pabrai Investment Funds, which he founded in 1999. His investment philosophy has been greatly inspired by two legends in the investment world, Warren Buffett and Charlie Munger, who have delivered outstanding returns and also garnered respect and admiration all over the world. Beyond his remarkable work in the field of investment, Mohnish is also a dedicated philanthropist. His book, Dhando Investor, offers a unique perspective on low-risk, high-return investing, making complex financial strategies accessible to a broader audience. Today, we are fortunate to hear Mr. Pabrai as he shares his invaluable insights on investing, market trends, and life lessons. So please join me in welcoming Mr. Mohnish Pabrai on the high stage, along with Gaurav Dalmia, fellow YPO, and the day chair for the day. Gaurav, thank you.
Good evening, everyone. My pleasure again to invite Mohnish. So, Mohnish is a legendary investor. I just finished reading his book, which is called Dhando Investor, and he gives some remarkable examples in that book why the Patel community owns $40 billion worth of hotel assets in the US, $40 billion. How Richard Branson built Virgin with very little capital, and so on. I will hand it over to Mohnish, and thereafter I'll ask him a few questions, and we'll go into generic Q&A. So Mohnish, try this one.
All right, well, it's great to be here, and I'm always excited to speak to YPOers. This is my 27th year in YPO, and I'm in gold now. So I used to have a head full of hair when I joined, and it's actually been a life-altering experience, like for all of you. And one of the reasons I actually like to speak to YPOers is that Buffett has a quote. He says that I'm a better businessman because I'm an investor, and I'm a better investor because I'm a businessman. And so actually, if you're running a business, or if you're an entrepreneur, it's the exact same brain cells that get used when you're making investment decisions. And so all of you have all the core tools already in place, far more valuable than an MBA or going to business school and all of that. And you just have to make a couple of tweaks in terms of how you think about investments. And the moment you kind of think about investments the way you think about allocating capital in your business, then it gets to kind of complete alignment. They're both the same. And I just want to start with a story. I like to tell stories. So in 1626, the Dutch settlers in New York, they were negotiating with the American Indians to buy the island of Manhattan from them. And so there was a guy, Peter Minuit, who was a negotiator for the Dutch, and they reached an agreement for the Indians to sell the island for $24. And that deal closed, and when people hear that story, they say, oh, the Indians got taken. Isle of Manhattan is so valuable, and $24 is nothing. All these natural harbors, great location. But let's say the Indians had a trust officer, and they had told this trust officer to invest this $24 for the benefit of the tribe. And let's say that that trust officer was somewhat competent and could generate a 7% return on that money. So there's something known as the Rule of 72. How many of you have heard of the Rule of 72? So we have a few hands, which is great. If you only take away from this evening the Rule of 72, from my point of view, it would be a home run. So The rule of 72 is kind of a mathematical hack that happens to work where if I want to know how long it will take money to double, and so if you tell me that I'm going to get 7% compounded, for example, and I want to know how long it's going to take to double, I can just do 72 divided by 7, and that's 10. So approximately 10 years, it'll double. If let's say I'm getting 5% a year, I can do 72 divided by 5, it's approximately 15. It'll take about 15 years to double. If I'm getting 25% a year, it'll take about 3 years. So if I want my money to double in 10 years or 5 years, let's say I want it to double in 5 years, I know I need a 15% interest rate. It just happens to work because of some quirk. So the Indians, with their competent trust officer getting 7% a year, in 10 years that money will double, which means in 1636, it'll be $48. And in 1646, it'll be $96. So if we take a 100-year period, that's 10 doubles. Every 10 years we're doubling. 100 years where 10 doubles is 2 to the power of 10. And 2 to the power of 10 is 1024. So we want round numbers. So we throw away the 24. So it's 1000. So by 1726, it's 24,000. And by 1826, it's 24 million. And 1926, it's 24 billion. And 2026, it's 24 trillion. And abhi 2 saal bache hain. For 2026, we're not at 2026. So you can take that 24 trillion and take out 15%, like 21 trillion or something, let's say. That $24 would be about 21, 22 trillion today. Now, if we look at the entire wealth of the planet, the wealth of every man, woman, and child, it is about $550 trillion. Out of that 550 trillion, US wealth is close to about 200 trillion. It's a little more than 1/3. So it is unlikely that 1/10 of US wealth would be undeveloped land in Manhattan. What I'm saying is that if you took the entire island of Manhattan with no buildings in it, just land value, it would not be 20 trillion. It'd be much less than that. So the Indians did not get taken. The Indians got a great deal. And it was a trust officer who screwed up because he didn't generate the 20%, the 7%. And 77% not a heroic rate. So if we go back, let's say the deal instead of 1626 was happening in 1526. So you had 2400 cents that this deal took place, and if you go back 100 years, you could have made the deal for 2.4 cents. And you would still end up with the 21 trillion. So every cent matters, right? And Einstein called compounding the eighth wonder of the world. And we humans have difficulty with the concept of compounding because it's not linear. It's basically on a log scale. We don't normally think in a log scale. But it's really important to think in those terms. My younger daughter, she went to NYU, and we were living in California at the time. I used to pick her up at like 1 or 2 o'clock in the morning from LAX, and we were about 50 miles away. So we had a long hour-plus drive back home. And, she's kind of falling asleep, etc. So one time I decided this is a good time to give a lesson on compounding. So I told her, hey, Momachi, I said, you're going to have this internship in the summer, and you don't really need the money. You're going to save about $5,000 over the summer, and you're 18, right? And I said that let's say we put that money in an IRA, a retirement account which is not taxed. And let's say you gave me power of attorney on that account, and let's say I was able to generate a 15% return on that $5,000. So I told her, look, basically 68 is 50 years, from 18 to 68. And we are doubling every 5 years. The important thing is how long things take to double. Life is all about how long things take to double. So I said, you'll get 10 doubles. 10 doubles, is a magical number. 1,000. So I said, at 68, you'll have 5 million. But you'll do another internship when you're 19. Maybe you'll make 6,000-7,000. And that'll be another 5-6 million. And then at some point you'll graduate and you'll get a job and you'll actually be able to save a little bit more. So by now she's wide awake, you know. So I said, how much money will you have when you're 68? She said, it's too big a number. My head will explode. So I was happy. She got it, you know. And I said the important thing is that you have to start early. You know, so there are 3 variables. When we look at the Indian story, there are 3 variables that go into the end result with compounding, right? So the first variable is starting amount, right? What do you start with? Second variable is what is the rate of return? And the third variable is the length of the runway. And these 3 have an interplay. So we saw that you can start with 2.4 cents with a really long runway and end up with a really big number at a relatively low rate of compounding. Or you can have a, you know, kind of above index rate of compounding, like I was giving my daughter about 15%, smaller runway, not that much starting capital, but still end up with a large number. So I think it's really important when you're young. You know, I was telling them when they were putting this event together, okay, YPO se kyun baat kara rahe ho? Especially YPO gold walon se kyun baat kara rahe ho? You know, it's like, it's too late, guys. You know, we needed to have this conversation 50 years ago. You know, but we have a few YNG people here. Can the YNG folks raise their hands? So I'm only directing my comments to you guys. The rest of them are just here for, you know, filling the seats. But you guys can actually do something about it, right? Because you have a runway. And so it's really important to start as early as possible. You know, Warren Buffett says that I bought my first stock when I was 11. I was wasting my time before then. You know, so anyway, I mean, I just wanted to just kind of just set the stage where basically I just say that these are really simple concepts. But Charlie Munger used to say you have to take a simple idea and take it very seriously. And compounding is a very simple idea, but it has a lot of power if you fully unleash it. So anyway, with that, Gaurav, let's see what you have in mind.
Thank you, Mohnish. So we all aware of Warren Buffett, and he takes complex investment ideas, dissects them into simple steps. And the trouble for most people that I talk to, and I'm an avid follower of Buffett myself and my own investments, and our time horizon for investments is 15, 20 years. But for a normal investor, how does he maintain a Buffett-like discipline when there's so much noise all around?
Yeah. So last year, 2023, Buffett wrote in his annual letter that in 58 years of running Berkshire Hathaway, and even more than that, probably close to more than 70 years of compounding, 12 investment ideas that he came up with move the needle. Now, if I go back to just the period when he ran Berkshire Hathaway, the 58 years, and he said that there was approximately one great idea every 5 years. There were 12 over 58 years. Over 58 years, he acquired about 85 companies. And I'm estimating he would have invested in something like 300 or 400 stocks over that period. So even if you take a total universe of 400 bets made over 58 years, it's a 3% hit rate by the god of investing. So hamara kya hoga? Why did it take Warren Buffett 58 years to come up with just 12 great ideas? And these ideas, the 12 great ideas, you know, he didn't name them, but we can guess them. They are things like American Express, Coca-Cola, See's Candy, ABC, that's a network, television network, Washington Post, Geico, hiring Ajit Jain, and so on, right? Hiring Ajit Jain probably was number one in terms of return, because he says that if you calculate the headhunter fees they paid, he created more than 100 billion of value for Berkshire. So that's like a, infinite annualized return. So why did it take so many years for this guy who's the best we know of ever to come up with just 12 ideas that move the needle? And to get to your question, basically, in 1972, Buffett and Charlie Munger bought a company called See's Candy. And it's a small California company. They paid 3 times book value. They were choking at the price. Warren at that time was a deep value guy, always wanted to buy things at a discount. Here he was buying a business where 2/3 of the money evaporated, basically it was intangibles. And they paid about, I think 13, 14 times trailing earnings for that business. And they were really choking on the price, where they finally said that if the family wanted even $10,000 more, they would have walked. And they paid about $25 million for that business. And he always left his managers alone to run the business. But he told his manager, Chuck Huggins, that on December 26th every year, I will set the prices for the following year. So he used to go to the See's Candy price list, and he raised the prices every year by 10%. And what blew him away was that they raised prices by 10% and sales went up. And then the next year they raised it another 10%. And this is, in a country with an inflation rate of 2, 3, 4%. And for 50 years they've been raising the prices 10%. And See's delivered an avalanche of cash. I would say in the last 50 years, I think they mentioned a few years back, north of $3 billion in dividends to Berkshire. And Warren and Charlie said that they could have paid $100 million, even $150 million for the business, 6 times, 5 times what they paid, and it would have been a bargain. But at that time, when they bought the business, they didn't know that or understand that. But it took them about 5 or 10 years, probably more, maybe like 15 years, to truly understand the power of See's and the power of brands. And in 1988, they made an investment in Coca-Cola. And at that time, he put 1/4 of the total book value of Berkshire Hathaway into a single stock, Coke. Huge bet. Some insurance company buying a, company they don't control. And Coke was a huge home run. And Warren said that if they had not made the See's investment, they would not be able to make the Coke investment, because they would never understand Coke. And the Apple investment, which was more recent, would not have happened without See's or Coke. So it was not actually a tech investment, it was an investment in a brand and consumer behavior. He understood consumer behavior. So when we look at investing, it has to be a complete no-brainer at the time you're making the investment. So whatever opportunity is in front of you, if you need a spreadsheet, it's a pass. If you need Excel, it's a pass. If you cannot do the math in your head that I'll put this money out today and in 3 years I'll get it all back, or in 4 years I'll get it all back, it's a pass. And there will be investments that will show up at unpredictable times, and at times sometimes when you don't expect. Our job as an investor is to be like a salmon fisherman standing by a stream with a spear. Doesn't know when a juicy salmon would go by, but he has to be very patient, waiting for a long time. The juicy salmon will come, but we don't know when it'll come. We don't know how big it'll be. And that's the nature of investing. It's very opportunistic. It's also an extremely forgiving business. In the case of Buffett, as long as he didn't lose a lot of money, 95% miss rate still made him the wealthiest human. So it's an extremely forgiving business. The best of us will be wrong half the time. Most of us will be wrong 2/3 of the time. But that's okay. The errors don't matter. What matters is the focus, that when you do find something great, that you keep it for a long time. So we have Rakesh Jhunjhunwala. Most of you are familiar with him. I think Rakesh was probably the greatest investor India's ever produced. And he was a split brain. I don't know how he did it, but he had one side where he's trading frantically every day, in and out, 3-4 screens in front of him, all this stuff. On the other side, he has these few stocks that he never touches. So, like for example, very, very early, he bought Titan. But what was remarkable about Rakesh is he then loaded up more on Titan, paying 16 times what we paid for the first stake. So most of us will never be willing to pay 10 times, 15 times what we paid for something 2 years before. We're not going to pay add another zero to that. He did that. In fact, he kept buying Titan repeatedly at higher and higher prices. And it ended up that I think when he passed away, he never managed money for anyone else, just his own money. $5.6 billion. And I think about 2 billion of that was Titan, right? So how many times did he need to be right? But he knew in this case he was right. And at the same time, he is trading in and out of hundreds of stocks, right? But he doesn't touch Titan. So that's a remarkable guy.
I just want to reiterate. So I was talking to Sanjeev Bichchandani, who's also a legendary venture investor, and I asked him, what's your secret and all of that. And one point he made was in his venture investments, he feeds the winners. If a company is doing well, he'll invest in every single round. And in fact, in his mind, he reserves almost 2/3 to 3/4 of the capital for future investing in case there is a winner. And that's how he makes big stakes in Policy Bazaar or in Zomato and so on and so forth. And I just found a statistic today. If Warren Buffett had not given away $55 billion worth of shares in Berkshire Hathaway, which he's given away since 2006, his net worth today would have been $293 billion, which would be $41 billion more than the current richest man, which is Elon Musk. So his net worth is after giving away $55 billion.
Someone asked Buffett, if a genie comes to you and gives you one wish, what will you wish for? He says, when they look at my corpse, I want them to say, man, he was old. And he wants to die really, really old, not because he likes to hang out with us. He just wants a long runway. He understands, like he said, first 11 years he was wasting his life. So he's been compounding now for 83 years. And that's what he wants to do. Just keep it running for as much as you can, as long as you can.
So let me ask you about the technology sector. So I'm defining tech in more classical way. High gross margin, not e-commerce, which is a low gross margin business. High gross margin, high growth, yet outlandish valuation. How would you make a trade-off of investing in tech, the American definition of tech?
Yeah, so all businesses, it doesn't really matter whether they are growing, whether they are flatlined cash flows, or whether they are declining cash flows. All businesses have a value, and the value is the sum of all the future cash that will produce till that business doesn't exist anymore, that will come out to investors, and discounting that back at some reasonable interest rate. Now, the problem we have is that we don't know what those future cash flows are. In most companies, we don't know that. So if I take a business like NVIDIA, for example, and if I had a crystal ball that told me for the next 10 years, these are the cash flows NVIDIA will produce. And let's say that crystal ball told me that in the next 10 years, NVIDIA will produce 2 trillion in cash flow. The market cap is 3 trillion. So a Patel would say, easy pass. And even someone like me looking at it, I would say that if I'm going to buy NVIDIA stock, one of the first questions I ask is, how much would it cost me to buy the whole business? I don't care about the stock price. I care about the price to buy the entire business. So let's say the price to buy the entire business is $3 trillion. So then the second question I would ask is, ये 3 trillion कितनी देर में मेरे को वापस आ रहा है? How long is it going to take me to get that 3 trillion back? Because I want it back as soon as possible, right? And if I come up with math that starts getting into more than 7, 8, 10 years, you've lost me. I have an investment in Turkey, and I'll give you some, if we have time, we'll go a little bit into it. But there's a father-son team that run that company, very gifted capital allocators. And they actually don't understand how gifted they are. I try to explain it to them, but I don't think they understand. And neither of them went to business school. And they tell me that we have really simple math that we run. Anytime we are going to make any capital allocation decision in the business, in dollars, we want the money back in 2 years. And maximum, if we are getting really euphoric, is 3 years. So he says anything we look at, any project we look at, that is the lens that I want it back in 3 years or 2 years. If you get your money back in 2 years, rule of 72, it's a 36% annual rate of return. 3 years is a 24% annual rate of return. Both are very acceptable. And they need to obviously see that. And I keep observing all the different investments and things that they make. Very few mistakes and very high returns because they just never put cash out if they don't have that. And so I think that it doesn't matter if we are investing in a tech business, a motel business, real estate, whatever. It all boils down to what am I putting out and how long does it take me to get that money back. And generally speaking, when we get to some tech businesses in this environment that we're in, there is a lot of euphoria. And so generally when you get to euphoria, you're not going to get these 2, 3, 4 year returns. And the good news with investing is that we can keep saying no. We can keep saying no to everything. And we can say yes once a year, once in 5 years. We can say yes whenever we want to say yes. So that's the great thing about investing is we've got a lot of freedom of when to say yes and so on. So
let me come to quant. So I was in Columbia in 1988, and David Shaw has just left Columbia. He was teaching at Columbia to start D.E. Shaw, which is one of the world's great hedge funds today. And I'd met him at that point. And it was a very niche idea at that point. And today, quant investing is a mainstream idea. We all know of Renaissance, which has delivered gross returns of 65, 67% for the last 20 years. What do you think about quant investing?
It's beyond my pay grade. So I would say that almost nobody has been able to do what Renaissance did and what Jim Simons was able to do. That's very much an outlier. And the best way to approach investing is that if you don't fully understand something, that's okay. That's the case with 99% of things in the world. We just take a pass. So quant, I don't have to waste brain cells. We move on. Somebody else can make a lot of money, and that's perfectly fine.
Let me come to India. So the S&P over the last several decades has returned about 9.5%. The Nifty has returned about 14%. After factoring in rupee versus dollar, risk premium for India, etc., what would you pick?
Today, I would pick neither. The S&P is at a trailing multiple of about 28 or 29. And in the year 2000, in September 2000, it had a trailing multiple of 26. And then the returns for the next 11 years for investors, including all dividends reinvested, was zero. 0% return after 11 years. And it wasn't just a straight zero. You had a very volatile ride. So there was periods in there where 30, 40% of the money had gone. And so it would have been difficult for most investors to hold on in that environment. What I find interesting about India is that India has far more tailwinds than the S&P has or the US has. Growing population, emerging and, massive amount of per capita and GDP growth. I mean, you can just see it everywhere. There's a big difference between investing in a great business and making a great investment. So we know, for example, that Hindustan Unilever is a great business. If I were to ask us to make a list of the truly exceptional businesses in India, most of us would not have difficulty coming up with such a list. Varun Beverages is an exceptional business. Is he a YPO?
No, I don't think so.
Okay. I don't want to offend people, Pardon? Okay. But exceptional business, terrific promoter, great management. I gave a talk last December at Flame University where I compared Varun Beverages to a Coke bottler based in Istanbul. And the Coke bottler based in Istanbul has roughly about 2 times the volume that Varun does. They bottle in about 14 countries. Coke just gave them half of Bangladesh. They do all of Pakistan, and they do all of Turkey and a bunch of other countries. And we can compare Coke and Pepsi bottlers around the world. The Coke and Pepsi bottling business around the world is very similar. The economics are very similar. And you can make some adjustments for growth rates and such. The Turkey business trades at about close to 1/8 or 1/10 of the effective valuation of Varun. And Varun trades at something like 5 times the effective valuation of all other Coke and Pepsi bottlers around the world. So if I look at Coca-Cola FEMSA in Mexico, phenomenal business. 1/5 the multiple, or less than 1/5 the multiple of Varun. And I see that play out in a number of different businesses in India where the businesses are exceptional. There's a huge amount of growth ahead, truly exceptional promoters and management. But you're paying a lot to have a seat at the table. In the end, the stock market, like Buffett says, is a voting machine in the short term. It's a weighing machine in the long term. So in the end, everything gets weighed appropriately. And so I had just suggested that if we were to go 5, 10, 15 years in the future, and we looked at these two businesses, Coca-Cola ISEC in Turkey and Varun Beverages in India, and we just looked at kind of where they end up 15 years from now in terms of investor returns. Varun's trailing PE is more than 100 in terms of current PE. And so I think that's the difficulty I think that India has, is that there are tremendous tailwinds, but it's also a place where there are lots of great investors and not that many businesses with exceptional corporate governance. So if you take the entire listed space, and let's get to the ones that have great governance and great moats, you might end up with 100 businesses. And all the money goes into those 100 businesses, the SIPs every month. So the result is predictable. And one of the things about investors is that investors love to have lemming behavior. So they believe that whatever has gone up recently will keep going up. And so it just kind of perpetuates, But eventually things do get to a head, and then a new cycle begins. So that's how I look at it. I think that the S&P, what I would do if I were in the US, if I was forced to be an index investor, I would take the equal weighted S&P rather than the normal S&P, where each business in the S&P has a 0.2% weight. It's equal weighted. That way you get rid of all the tech euphoria. And the Nifty in India, I think it's been a great place to be, but I don't know whether I could be very bullish about where it is 10 years from now.
So let me ask you a businessman's dilemma that we debate in our office all the time. So let's say I have two options in any business. One is I can do lower ROCE business, which is high growth in my industry. I can veer towards that. Or on the other hand, I can veer towards a higher ROCE business, which is more niche and therefore has lower growth. As a businessman, my tendency would be, let's go with the high ROCE. Growth matters less. But the markets reward exactly the opposite. They won't care whether I'm in the low ROCE business or not, but they'll reward growth. How do you balance this? It's not either or. How do you balance this ROCE versus growth?
Yeah, so I think that this is actually the dilemma Berkshire Hathaway faces. So if we look at something like Berkshire Hathaway today, it's 800 billion market value. They have to put 50, 60 billion out at a time to move the needle. And there are very few places that you can put 50, 60 billion one shot. How many businesses in India have a market value more than that? So the conclusion Buffett and Munger came to was that we have to keep running the runway at a lower rate. And so I would say between the two, it's important to keep compounding, and it's important not to be the flash in the pan, if you will. So if you've got some consistent growth, but it's low ROE, and at the end of the day, it boils down to opportunity cost. So you have limited dollars to invest. If in the near term one is giving you a high ROE, you can put money there, but you may not be able to put much money there. The other one may be able to absorb the rest. And that's how we do it. So everything boils down to opportunity cost.
My questions are over. What I'm going to do is I have audience questions, and then we'll also open it to the audience.
Sure.
So first question, can you generate serious wealth by investing into passive index funds or into mutual funds?
Yeah, I think you can definitely generate great wealth. We've seen that. The important thing is length of runway. You start early. The second is, the good thing about this group is God has been kind to all of us. We also have significant annual earnings, and we can push that in as well. And yeah, so I think if we get a long enough time horizon, and we don't need to have heroic rates, you can compromise between the rate of return with the length of runway and starting capital and so on. So absolutely, you can do well with the passive. In fact, I think you're more likely to do better with a set it and forget it approach than with some advisor who's telling you, we're going to buy this and sell this and all of that. I think you're going to do far better just having a very basic vanilla approach.
How to overcome greed and fear? Don't read the newspaper.
Well, we don't need to overcome greed and fear. All we need to do is we need to be fearful when the world is greedy. And we need to be greedy when the world is fearful. So I'll just give you an example, which I was going to go into I manage about 1.1 billion, and I have the most weird asset allocation I have had in 35 years as an investor. I've never had this weird allocation. 75% of the money is in 3 stocks in Turkey, and another 20% is in 3 coal stocks, 4-lettered word, coal, in the US. And the other 5% doesn't matter. But I think about this quite often, and I think that what I really need to do is the next 10 years, 15 years, just do talks like this and do no work, and life will be great. So I started going to Turkey in 2018 because it was screening as an extremely cheap market. It was just, I had a friend in Turkey, the diehard Ben Graham investor, wonderful guy. And I said, Haider, I'd like to visit you in Istanbul, and I'd like to visit the companies in your portfolio. And is that okay with you? He said, oh, no, come, we'll have a great time. So I said, here's the rules. I only want to visit companies that you actually have money in. Don't take me to any companies you have no investment in that you think is good or whatever. And I said, I want to start with the one that you have the highest conviction, most money, and then we go down the list. And I went the first year in 2018. I visited about 20 businesses, really was amazed at a few things that I came across. Then I went the next year in 2019, and Haider would send me the list of businesses that we were going to visit, but I never did any work on any of them, because I said that I want to do the work after meeting the managements and all that, some base level. I have some base level knowledge, then I'll spend time drilling down. I was just too lazy to do the work up front. So we were driving to this company. I said, Haider, this company, I haven't looked at it. Can you tell me about it? He said, yeah, its market cap is 16 million, 1-6, and liquidation value is 800 million. So I said, fraud hai kya? Like 2% of, I said, what do they do? He said, they rent warehouses. So I said, why is it so cheap? He said, everything is cheap in Turkey. The first business I visited with him was a bank trading at a PE of 0.1. Bank was trading at a PE of 0.1. 0.1 means that 1 month's earnings is the entire value of the business. And but that's a separate story. I couldn't invest in something that have too much hair for me also. So anyway, this is the father-son team that I met. They look like very smart people, honest people to me. I went after that and visited the warehouses, and then I told my guys that buy every share, just take out the ask. So Turkey has a rule, the individual stocks cannot go up more than 10% in a day. Maximum any stock can go up is 10%. I told them, you tell the broker up to the 10% limit, above the market price, buy every share available of this company that was the 16 million market cap. For $8 million, I got 1/3 of the company. The father, son who run it, they have 42%. The Indian guy with the great mustache is at 33%. And I meet them every year. I tell them, listen, I'm your cheerleader on the sidelines. I don't want to do any work. I don't want to be on the board. I just want to be your silent partner. And they are happy with it. I'm happy with it. Everyone's happy with it. That company has a value now in the stock market of $1 billion. The lira, which is why everyone was exiting Turkey at the time, when I made the investment, it was 5 lira for $1. Now it is 33 lira to $1. So the lira has collapsed. But the collapse of the lira meant nothing, which I knew even then, because I own warehouses. They are made of steel and iron and concrete and land, which is all inflation indexed. We have the cement guys right here, completely inflation indexed. So I said, there's no currency issues here, it's all okay. The liquidation value of the business, which used to be 800 million, is now somewhere between 2 or 3 billion. So I cannot sell, still cheap. And it took me a few years to figure out that I had not bought a cheap asset where something was really cheap. What I had actually bought was an asset with 2 gifted capital allocators who were going to compound this thing. Just last month, I was in Turkey, went to dinner with the son. The father doesn't come to too many dinners with us. So he asked me a question. He said, what is my business going to look like in 20 years? He's asking me, the Indian guy, okay, who's not even in Turkey all the time. So I told him, listen, man, it's really simple. The wealthiest families in Turkey are all 2nd, 3rd, 4th generation. They are professional managers running those businesses. The families are no longer running them. You are pounding day in and day out. And you are wheeling and dealing day in, day out. And you have these very clear metrics on how you invest. So I said, you're 39. I hope you're excited about this business when you're 70. And if you're excited about this business when you're 70, you will be the wealthiest family in Turkey. Because it's just math. You just keep compounding, it's just math. And my job is to just cheer you on and do nothing, So basically the thing is that business is, I think, like 350 million or something out of the pie. It's a family business. It's the Pabrai family business. We are not the founders, but that's okay. We don't need to be the founders. And we don't do any work, and that's also okay. So it's all okay. And the other 2 businesses Turkey was just so cheap. It's just ridiculous. So the coal business in the US, just to tell you kind of how things work, is let's say there's a company that will produce $1 billion a year for 50 years. And then it goes out of business. So it's going to exist for 50 years. It's going to pump out $1 billion a year. What would you pay for that business? What would you pay? 50 billion aane wala hai 50 saal mein. The market was asking me to pay less than 2 billion. US listed company, New York Stock Exchange. No one's interested. The Indian guy with the mustache is interested. So we loaded up on these coal companies. And not only were we buying 2 billion for 1 billion, we're buying billion of cash flow for 2 billion, they're buying back shares, and there's no restrictions on buying back shares. So they'll, in a few years, they're no long-term holders of that stock. I think we are one of the only guys who own the stock. A lot of traders. And we'll just sit there. And India, the funny thing is those companies in the US, their major market is India. So we cannot produce iron and steel without metallurgical coal. India has massive needs for metallurgical coal, but it doesn't have much metallurgical coal in the country. So it has to import. And there are only like 6-7 places in the world where you have that quality of coal. And no one is investing, no one will invest in a coal mine, no one will finance a coal mine. So that's all fine. It's all locked. We just sit here. So we don't need NVIDIA, So my take is, and I don't need all these bets to work, you know. If they all work, then, you know, hallelujah, you know, we don't know what we'll do then, you know. But even half of them work, it's okay. 40% work, it's okay, no problem. And all of you actually have the skills because you're hardcore businessmen. You're hardcore dhando guys. You know how to allocate capital in your businesses. If you know how to allocate capital in your businesses, allocating capital outside your business is the same, right? It's exactly the same. So whenever someone says to you, okay, you know, we should invest in this IPO, we should invest in this and that, this is the only question I have. What is the market cap and when am I getting that money back? And if I'm not getting that money back in 3 or 4 years, I'm not interested. So the interesting thing about the stock market is that if you say that I only want to invest in companies that are PE of 1, they exist. PE of 2, they exist too. And PE of 100, they also exist. So the market will deliver whatever you want. You can set whatever threshold you want, and then you're done.
Next question, I think you've already answered, but just for the sake of it. If there's one big takeaway from today's session, what would it be, I suppose?
Well, they should answer it. What is the takeaway? Please raise your hand. Pardon? Go. I'm telling you, man, Turkey is the place to go. Don't put it in the Nifty 50. Pardon? Yeah, exactly. Yeah, exactly, yeah. But the thing is, you know, I was talking to the CFO of a company that's like Tata in Turkey. They're like one of the biggest groups, very blue chip group. And he was telling me, he said, every country has a national sport. He said that in the US, it's poker. And he said poker is a game which is a mix of skill and luck. In China, it's baccarat, only luck. In Russia, it's chess, only skill. He said, do you know what the national game of Turkey is? I said, why don't you educate me? So he said, it's backgammon. And the Turks are mad about backgammon. They have all these places they go and play backgammon, total luck game. There's not much skill involved. And he said that the average Turkish investor wants to buy a stock at 10 o'clock and sell it at 3 o'clock and make 10% and then do the same thing the next day. And Buffett has a quote. He says the stock market is a mechanism to transfer wealth from the active to the inactive. So when I was looking at this 16 million market cap company, my concern was there'll be no liquidity. There'll be no shares available. Who will sell this company, right? Massive amounts of liquidity. I mean, I was shocked at the amount of trading volume. The average Turkish company, if you exclude the founder's stake and the foreign investors, cycles through the whole market cap in 11 days. Every 11 days, it's cycling. It is what I would call an orgasmic market to invest in. You know, for people like us who want to buy something and never sell it, there could be no better place than that. Because you're dealing with people who are trying to get a value of a business for the next 6 hours, right? They're trying to understand what is this going to give me in 6 hours. And if I'm willing to go to 6 years, and he's at 6 hours, I have a huge advantage.
Changing topics a little bit. What does the next US presidency look like?
You know, I don't know, have any of you read Robert Caro's books? Are there any Robert Caro fans? So anyway, every 6 months, I go to Kerala. I really come to India only to go to Kerala. You know, it's more interesting than Delhi, with due respect. And I have these 2 masseuses who work on me 3 hours a day. So all I do in Kerala is that I have my 1.5 hour massage in the morning, 1.5 hour massage in the evening. I have a do not disturb sign on my door, and I read Robert Caro. And Robert Caro, if you don't know, I'll just digress for a second. There's a documentary on Netflix, probably available in India, called Turn Every Page. And I don't think there is any writer on the planet or researcher on the planet as good as Robert Caro. So this guy is now like 93 or something. He spent about 10 years writing each of his books. He wrote 5 books, and he's working on his 6th one. I hope he finishes the 6th month before he dies. It'll be very sad. So every time I come to Kerala, I bring a Caro book with me. Like this time I bought master of the Senate. It's 1,000 pages. 4 out of his 5 books are on Lyndon Johnson. And the thing about the United States is, because of the brilliance of the founding fathers and all this separation and distribution of power between the presidency and the Senate and Congress and the states, is the US does well no matter who is the president. Really, quite frankly, irrelevant. Like right now, we don't have a president, Everything is jamming. And the reason everything is jamming is because on the status quo basis, the country works. So yeah, we won't get some new rules, we don't get some new laws, we won't get new things. I mean, we've had logjam, we've had parties not agreeing. Government shutdowns, we have these parties not agreeing, we have all these things going on. In a parliamentary democracy like we have in India, Modi cannot be in power if he doesn't have a majority of the lower house. In the US, the president is elected separately from both the houses. He may or may not control both of them. And many, many times in the history of the US, the president has been from one party and the houses are controlled by the other party. So it's complete logjam. And through all of that, out of the 550 trillion, 200 trillion is in the US. At the end of the day, that country had 4% of the global wealth when it was formed. And now it is 30% of the global wealth, right? It just moved without having 30% of the population. So I don't know who's going to be the president, but it don't matter. It's okay. And read Robert Caro. Start with the first one. So every time I come to Kerala, I bring one book, right? The Caro book. And what I feel really sad about is after 2 more trips, I'll have no more Caro books. And then I don't know what I'll do with my life. So I'm trying to find Caro number 2, but there's no Caro number 2. But you should watch the documentary, Turn Every Page. If you watch that, which is about Robert Caro and his editor, and then you go to his first book, The Power Broker, it's a page turner. You won't be able to stop reading it.
We have 3 more questions here, which I can't really ask because we're running out of time. So I want to open it to the floor. But you can ask these during dinner. Yeah. So may I open it to the floor? We can start from here, and then we can go around.
You talked about sort of the criteria to use when to buy, right? When do you recover that, whatever the market cap is. So, I mean, that's good knowledge to have, but what I usually struggle with is when to sell. So I would love to get your thoughts on that.
So if the job is done right, it never needs to be sold. And what we should really be thinking about is when we invest, we should think of it like a family business that can never be sold. So if, Buffett uses the analogy of a punch card. He says that you have a card which has 20 punches and then you can't punch it anymore. He said each time you buy a stock in your whole life, you punch it once. And when you've bought your 20th stock, you cannot buy any more stocks. So if that was a rule that was imposed on you, you would think long and hard about each stock. And one of the things you think about is, can I live with this forever? So we are always trying to buy things at a discount. And that's one of the biggest mistakes I made through most of my career. Most of my career, my model was buy something at 40 or 50 cents, sell it at 80 or 90 cents, go back and buy another one for 40, 50 cents. And it took me like 25 years to figure out that is so stupid, that these compounding machines that come along are so rare. And if you find yourself in the happy position of having one of those, then you should even keep it when it is overvalued. You shouldn't keep it when it's egregiously overvalued, but you should keep it when it's overvalued. So give a lot of benefit of doubt to the holdings that you have in terms of whether or not they're overvalued. Give them a lot of benefit and try to keep them for a longer period. So if you have a family business, you do not do a calculus every year saying, what can I sell this for? Should I sell this? You just don't do those types of things. If you have a house that you really like, you really don't care what somebody will pay you for it. I bought a home. I moved to Austin, Texas recently. I bought a home. I don't like to move. And I said, Avi, I'm never moving. This is the home. This is it. We're going to die in this home. Then the realtor who sold me the home, he calls me and says that some couple from Connecticut, the Wall Street Journal did a feature of library of my home. So after that, there was some interest. So this couple in Connecticut said, they want to buy your home. So he said, yeah, no, I already told them it's not on the market and that you will never sell the home, etc. So they said to him, everything is for sale. Everything on earth is on sale for a price. So I told him, they are absolutely right. Everything is on sale for a price. So I told them, tell them this is the price, which was about 3 times value of the house. Instead of going away, they came back and said, can you show us some more pictures? Then I told them I don't want to waste time. I told them, write me a 3-paragraph essay of why you want to buy a home for 3 times what it's worth. They went away. Nobody likes to write anything. And thankfully, I get to keep living in the same house that I have. Really didn't want to. That would have been a sad day if they said, okay, we'll pay 3x, Then I would have been, regretting that. But that's okay. So basically, if the job is done right, we never have to sell.
I was really amused. At least a couple of times you said, the Indian man with the mustache. So, but I can't help but ask, where do you get your mustache done from? My follow-up question actually, when you were talking about the candy company and all of that, right? And like every time the prices increase, so basically you were describing the Veblen goods. And then the other stock price, or whenever the price kept increasing of the stock, and then he would buy some more.
Yeah, Titan, yeah.
The Titan one, yeah. Rakesh Jhunjhunwala.
Yeah.
So this all seems like a whole Veblen concept happening over there, that the demand's kind of going up when the price is going up. But so is that what you mean when you say consumer behavior and brand that you buy into, or how does a product even achieve Veblen status? Like, what have you seen like businesses do so that their ordinary product achieves like a Veblen status?
Yeah, those are 2 great questions. So first of all, on the mustache, I have these Chinese men come up to me, okay, and they say to me, how can I have a mustache like yours? And I say to them, some things are just impossible. Genetically impossible. So, but it did take me about like 5-6 years to figure it out. And then we got a hang of it. So it took some time. I think the question about brands and consumer behavior is a really complex question. And I'll give you an example. Buffett and Munger, they bought a company called Kraft Heinz. And Heinz used to be by itself, it bought Kraft cheese. And it became one company. On the Heinz side of the house, they have ketchup. And they have the ability to raise prices much more than on the cheese side. So on the cheese side, even a tiny amount of price increase and consumers switch to another brand. So people don't seem to care which cheese they're buying, but they seem to care a lot about which sauce they're buying. So the ketchup, the humans have some kind of taste memory or taste history where they are particular about the kind of ketchup. And they're not so particular about the kind of cheese, right? And so in the same company, they're facing this issue. And so this notion of this consumer behavior and brands is really, really complicated. And the devil is in the details. And so when Buffett and Munger bought See's Candy, they saw this 10% price increase was going on. And they loved that. That was just awesome, right? And See's is very much a California phenomena. It's very popular in California. They would open a store in Arizona, it would fail. They'd open a store in Chicago, it would fail. They tried 100 things all over the world. There's even a store now in Dubai, for example. And they've had a lot of difficulty with the growth of See's outside of California. And it's boxed chocolate. Boxed chocolate is not a growth category. So it was actually, it's not only the boxed chocolate, it's boxed chocolate with dedicated retail. They have their own See's candy stores, right? Which again is another weird thing, you know. So for whatever reason, that equation worked in California. And it's worked over 50, 60 years that they've owned it with people have changed, everything has changed, technology has changed, but the candy is still going. When they encountered Coke, it blew them away. One of the big reasons it blew them away is because Coke travels so well. Coke travels easily to any part of the world. You can put up a Coke factory anywhere in the world, start producing it, and instantly there's demand, right? I mean, that brand has magical power. So they looked at C's, they looked at how powerful it was, but they couldn't grow it. Then they looked at Coke and they said, this is C's on steroids, right? And so then when they looked at Coke and they saw how powerful it was, they went all in, right? And so these insights about, brands traveling, not traveling, Coke, one of the things about difference between Coke and candy is there's no aftertaste with Coke. What that means is that you can consume a huge amount of Coke, but candy has an aftertaste. We will start hitting kind of upper limits relatively soon with candy that we won't hit with Coke. And person can easily have 5 Cokes a day or 5 Diet Cokes a day. They wouldn't see anything unusual about that. But what I've been able to glean is I don't consider brands and consumer behavior my forte. I think it's a very complicated area that seeing is believing. I don't know whether there are rules that go across, like you see that C's doesn't travel and Coke's travels, and you cannot raise the price of Kraft cheese and you can raise the price of ketchup. I mean, those are things I would never be able to forecast, right? So basically, if you are able to forecast those things, you can have some major home runs. But it's not that easy. But I think that there are a lot of rewards if you can figure it out. Well, thank you, Gaurav. It was a pleasure, and thanks to all of you for being such a great audience, and it's always fun for me. Thank you.